Welcome to Econoday Unplugged. Today is Tuesday, September 4th, and summer is sort of over. I am Ann Picker, Econoday's chief economist, and with me today are Mark Pender in the U.S. and Jeremy Hawkins in London. Mark, it looks like we've had some pretty good data this morning so far.
Yeah, well, let's start off. We had, it's been an interesting run for the manufacturing data. We had the ISM manufacturing report this morning, really came in well over expectations, 61.3. This sample had slowed in prior months, but is just right back at its and really its strongest form, with orders rising, backlogs climbing at a faster rate, and employment. And this is a manufacturing sample, employment showing strong growth. But there's also capacity stress issues. I mean, delivery times are continuing to lengthen. But even though inventories of both raw materials and finished goods, which have been struggling to climb, did climb. But input costs are still very, very, very high in this report, although they're still a little bit lower, less high than they were in prior months. What's also interesting about this report is the ISM tracks 18 manufacturing industries. Now, 16 of these showed growth, which is pretty good, but primary metals now for the second time in a row, and this is where tariffs are in play. Primary metals were a drag on the manufacturing sector, so that's something to keep your eye open on. But the market economics sample released earlier this morning showed less strength, actually showed a little bit of moderation in the month, as did most of the regional Fed reports on manufacturing. So it's kind of a close call on what we can expect for the government's data for the month of August. And the first edition of that we'll see next week from Friday with the industrial production report. But I imagine that the ISM strength, which is very closely watched, will keep up expectations for at least steady growth in industrial production. And we also are getting the employment situation report on Friday. And since we'll stick with manufacturing, the Econoday's consensus for payroll growth is a very solid 21,000 for this sector. So, and overall, it's the consensus now is 195,000 growth in non-farm payrolls. That's pretty close to 200. And last month, July, was a slow month. It was 157, but that's still very, very strong. And we're also looking at expectations for an incremental uptick in average hourly earnings, which is a wage measure, a 0.3 monthly consensus percent, which would be the same as the prior month, with the year-on-year rate seen going up 0.1 from 2.7 to 2.8. Now, if we get a report like this, it will probably cement expectations for a rate hike at the September FOMC. This would be it wouldn't be overheated report, but this report has been consistently moving higher or consistently showing very high rates of labor market strength. And of course, the question here, the eternal question, is how deep is the available labor pool? Will we be pulling some people who are outside the labor pool back in? Because for employment to continue to grow at this rate, new players, new workers have to show. And to just real briefly talk about the prior week's data, it was an eventful week last week. And really, I guess what the upshot of that is a little bit of slowing growth and a little bit of slowing price pressures. Now, that's in contrast to the expectations for the employment report. But we did see in the prior month, in July, a little bit of slowing in consumer spending, still really very, very positive, but it's been incrementally coming down. This morning, we have the unit vehicle sales are coming in. About half the totals are in right now for the month of August. This is an early indication on consumer spending strength in August. And vehicle sales are kind of what's been holding back the economy, or at least the consumer sector, and especially the retail sales report. It's been incrementally growing, but in a subpar way. It looks like the early indications are August, maybe something on par for growth or something subpar for growth. So it'll be interesting to see if the employment report can really show that strength. Even though I think other reports are showing what really is a little bit of a welcomed, less hot economy and a little bit of easing capacity stress.
Mark,
Yeah.
I think if I noticed correctly, we just had the Atlanta Fed Nowcast forecast, and they've just revised up their growth forecast for the third quarter to 4.7%.
On the high side, yeah.
A, what's their track record like? And B, do you think that's reasonable?
I think that's probably outside. I think their track record is on the high side. That in the prior week we got initial trade data for the beginning of the third quarter, and it was this was on the goods deficit, and it was very, very high. So looks like we're going to get a drag, at least initially. We're just at the very, very beginning of tracking what the third quarter is going to do. But that should probably pull that down, pull GDP, pull it back a little bit from the exceptional 4.2% growth of the second quarter. The bulk of that will be in consumer spending, which I've said seems to be slowing a little bit. But I think the wild card, and maybe that's what the Atlanta Fed is really tracking, is inventories. Inventories are very, very low, and especially relative to demand, which is a real big positive for the economy. It really is a key positive. And some of this was apparently tied to trucking limitations and new trucking regulations, which have been slowing down deliveries. But we saw the inventories rising a little bit in the ISM, and we saw initial inventories really for July and wholesale and retail sector really pop up strongly, and that will be a positive for the third quarter outlook for GDP. So I would imagine the consensus here, looking at the early numbers I've seen, is probably more in a 3% range right now, 3.5% range for third quarter GDP, which would be an excellent quarter. But if you want to take out inventories out of that, then maybe that would be more like in the 2.5% range. Again, that will all come out with consumer spending, and like I said, by the end of the day, with August unit sales for vehicles, we're going to have a little bit of better handle of what to expect for third quarter consumer spending.
Okay,
Mark.
Yeah.
Mark.
Yeah.
I have a problem with the nowcasts simply because there are several Fed banks that publish them, including the New York Fed, which was closer to the 2.5 number. What is the difference? How can anyone have any faith in these numbers if there is such wide discrepancy in the estimates?
Well, it's like our consensus forecast. I mean, if you look at, you have, I guess, you would have pessimists, optimists, and maybe realists in between, or something in between.
Hopefully some realists.
Right. If you look at just the Econoday's consensus, and this is our panel of who we considered, and we've drawn in, top forecasters, and we rely on this, and on our record. And the consensus for this month in this group is 150 payroll growth, 150,000 to 237,000. So that is quite a wide range. And so, it's every economist, I guess, has their own view, and it's interesting to have these casts. And I think how you should look at them, it's just like consumer sentiment or consumer confidence, actual data. These two reports have been going in different directions for the last year and a half. Consumer confidence produced by the Conference Board has been going through the roof. Consumer sentiment produced by the University of Michigan has been flat. So how do you judge these things? These are, long established surveys with proven track records and strong samples. Maybe you just take something in between. I think that's probably what the reasonable look would be, and we're having all these different inputs, but I think that's probably what it is, and that's how I was saying I think the GDP call is probably in the 3% range right now.
Thank you. Moving on, talking about trends and relationships, Australia has just celebrated its 27th year without a recession, which I think is quite amazing. The Reserve Bank of Australia has not changed their policy rate for 2 years. It's currently at 1.5% and has signaled that it's going to remain there for some time in the future. Governor Philip Lowe last night sounded upbeat about the economy, and according to him, the first half of 2018, the economy has estimated to have grown. Business conditions are positive, and non-mining and business investment, which is very important, is expected to increase. Still, the bank was no hurry to raise rates, given that wage growth and inflation remain low. An added reason for caution was a recent increase in mortgage rates by Australia's number 2 lender, Westpac. However, Lowe did not acknowledge the move in his short statement, while repeating average mortgage rates were still lower than a year ago, and he still maintains that the slowdown in the housing market was saying something still and more good competition. Second quarter GDP is going to be released tonight, U.S. time, and it's expected to grow at 0.7% on the quarter for the second quarter and 2.8% year over year. This is slightly lower than the first quarter of 1% quarterly increase and a 3% annual increase. Moving on to Europe.
Okay. Well, I'll say, as you were mentioning, Australia may not have had a recession for 25 years, but somewhat offside European borders. But notice South Africa has just fallen into its second recession in the last 10 years. And I thought to mention that just in the context of what's happening in emerging markets and some of the implications of that for Europe, and particularly for the likes of the Swiss franc. I think unless you've been living in a cave, then it's been fairly apparent that financial markets, for the emergers anyway, have been in considerable turmoil for some while now. Just last Thursday, we had the Argentinian central bank hiking interest rates by, 15 percentage points to 60%. The peso now is still down, about 50% so far this year. We've had the Indonesian rupiah at a 20-year low yesterday. Brazilian real's down more than 20% so far this year. Even Turkey's talking about the possibility of hiking interest rates later this month. So emerging markets very much in turmoil. Now, all those currencies are trading significantly weaker, but of course the counterpoint to that is that some currencies have got to go up. We've been talking about a sort of strong dollar environment for some while now, but even stronger than the dollar has been the Swiss franc. Now, for people who remember, the SNB was forced to pull the plug on its lower target limit at 120 against the euro, going on for 3 years ago now, back in January 2015. We saw the Swiss franc strengthen aggressively, since when it's been very pleased to see euro Swiss move back up towards the 1.20 area. And indeed, we're at that kind of level back in the end of April time. However, with all the volatility in the emerging markets, we've started to see a fresh flow of capital moving back into the Swiss franc. And as I speak, we're talking around about 116, 115 now against the euro, effectively meaning appreciation against the euro around about 6% or so since its peak period. And indeed, the currency's also strengthened against the dollar itself. Now, why is it happening? Well, I suppose you've got to say that for the Swiss franc, historically, it's always been seen as safe. Its track record on that basis is pretty well second to none. Inflation's always low in Switzerland. And of course, over the long run, that's a key determinant of what happens to foreign exchange rates. More importantly, perhaps, so it's also got a huge current account surplus. So there's no funding problems there when we get global liquidity shortages, which, of course, is always a potential issue when we get this market volatility. And indeed, the government's got a small surplus. Now, you don't buy a Swiss franc for interest rates. We look at the benchmark deposit rate out there for the Swiss National Bank. It's currently minus 0.75%, so the lowest easily amongst all the major central banks. And certainly as far as bond yields are concerned, 10-year Swiss franc bonds are currently trading at about minus 0.13%. So again, lowest amongst industrialized countries. But nonetheless, we've seen this capital inflow going into the Swiss franc because of its safe haven status, and it's starting to cause some real problems for the Swiss National Bank. This morning we had Swiss inflation update for August. Now, that showed inflation at 1.2%. The good news is that's its highest level since November 2018. But the bad news is, if we look at where the inflation's being generated, import prices going into Switzerland are running at 3.2%. Domestic prices within the CPI are running at just 0.5%. And essentially, they've been flat over the last year. So domestic prices really remain very soft. And the worst case now for the Swiss National Bank, which, like the ECB, is trying to boost inflation, is that if we continue to see the Swiss franc strengthening, it's going to weaken import costs and so undermine what has been to date the main boost to headline inflation. So if we continue to see the Swiss franc strengthening, it's going to give real problems for the SNB monetary policy. Now, we're a couple of weeks from Thursday, we'll have the next Swiss National Bank monetary policy assessment, and it's going to be really interesting to see what they have to say about the level of the Swiss franc. There haven't been too many signs of intervention from the National Bank over the course of the last few weeks, but there's got to be a real chance that they may be waiting for the market to become long and then come in and perhaps hit the currency aggressively. So I think for investors looking at the Swiss franc as just an obvious safe haven call, it may be getting to the kind of levels now where you need to be a little bit careful.
Jeremy?
Yeah.
Are they talking about a possible, or does this raise the possibility of further official negative interest rates for the Swiss National Bank?
Well, it's going to be an interesting one. I think if we go back a couple of months or so ago when the Swiss franc was weakening, markets were finally starting to contemplate the possibility, when will the SNB actually raise interest rates? Although the expectation was there was not until perhaps the back end of next year at the earliest. Now, though, yes, I think they've got the SNB pointing out that its two main pillars of policy are, one, negative interest rates, and two, its willingness to intervene. So I think if we see intervention coming about and that not working, then you've got to think that they could actually come out and reduce interest rates even further. The current target band they have for 3-month Swiss franc LIBOR is minus 1.25% to minus 0.25%. And perhaps they'll take another quarter percentage point off that. But certainly, it's very interesting times out at the moment.
Another question I have, Jeremy, is are the Swiss big importers, and this is related to the inflation impact?
Sorry, say again, the Swiss...
Are Swiss big importers? Are imports a major thing for the economy?
They are. I mean, they have this huge current account surplus, and that's built around really exports of financial services more than anything else. But yes, they do lack commodities and everything else. So they have to import them. And that's, one reason why you tend to find swings in Swiss inflation being, quite heavily linked to what's going on in the exchange rate. But of course, people have been talking about the strong dollar, but that doesn't matter for Switzerland when the Swiss franc's even stronger. So that's helping to keep down the cost of commodity prices going into Switzerland itself.
Thank you, Jeremy. Until next week.